Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Tracy Reinick, Senior Equity Strategist at Zacks. Tracy manages the Value Investor portfolio and she hosts the Value Investor and Zacks Market Edge podcast. So we are talking about value investing today. We'll talk about the outlook for value investing, and Tracy will also share some of her favorite value stocks that look very attractive now. And I will then talk about some value ETFs that investors could use. This should be really interesting. So I'm really looking forward to this conversation. Tracy, welcome back on the show.
Thanks for having me. I'm excited too.
Yeah, so to start off, tell us a little bit about classic value investing. What exactly is value investing? What defines value stocks? And talk to us a little bit about Ben Graham, who's sometimes called the father of value investing, and also about his most famous student, Warren Buffett.
Yeah, value investing has been around a long time, and it is considered to be the most successful of the investing strategies. But if you were just taking a look at the last 5 or maybe even 10 years, you wouldn't be getting that impression because growth has dominated over that time period and continues to somewhat dominate here in 2021. But we get these occasional spurts of value, which we have seen to some extent here in 2021 as well. So it gives all the value investors hope that maybe soon enough their type of investing strategy will become the dominant one. But that being said, I think just a lot of people really like value investing because at its core, it's about buying a stock that is being ignored by the rest of the stock market and is basically either cheap or somehow on sale. And I think as humans, all of us really like to get some kind of deal on whatever it is we're buying, including on a stock. So it has this real attraction for a lot of investors that they could get a stock that everybody else is kind of ignoring and that maybe is due for a rebound of some kind or a recovery. And that's where, some big money can be made in investing. So that's kind of the key component to value investing. But as for Ben Graham and then, of course, Warren Buffett, as you said, Benjamin Graham is considered to be the father of value investing because he's written one of the best books on value investing called The Intelligent Investor. Now, he was a professor at Columbia University as well as a money manager, managed his own fund, so to speak, back in the 1930s, 40s, and 50s. And he was successful at deploying the value type of investing strategy. Now, that is considered to be the classic type of value investing, which is basically cheap fundamentals. So price to book ratios, price to sales ratios, PE ratios, all of that on the lowest end. And that if you get those earnings for a low price, then you're getting a deal on the business. Now, there's like a lot else he talks about that investors need to do other than just the ratios, but you can start with the ratios as a screening tool and then dive deeper into the business to figure out what makes it tick and why it might be so cheap and why the street might be ignoring it. But he gives you a lot of successful tips and strategies in The Intelligent Investor. And that's the book that Warren Buffett read when he was 19 that he said changed his life. And then he went on to work with Benjamin Graham at his fund. Also, he was a student of his at Columbia, and then he deployed the similar strategies in his own investing through Berkshire Hathaway over the years and kind of continues on that tradition, because Ben Graham died in the 1970s, so he's no longer with us, but his book lives on, and his mentoree, his mentee in Warren Buffett lives on too for now. So value investing, it has been, as we see with Warren Buffett himself, considered to be one of the greatest living investors ever. It does have the ability to be an effective investing strategy, but it does have these cycles where it goes out of favor and then comes back into favor ultimately. So those times when growth outperforms is when it gets a little bit tricky for the value investor.
Right. So as you mentioned, this classic value investing, it focuses on stocks which are cheap relative to their fundamentals. But like beauty, value is also in the eye of the beholder. And lately we have seen some changing definitions of value. Two recently launched ETFs, they use somewhat different or enhanced value investing strategies. They focus not on typical value factors like PBP and EV by EBITDA ratios, but they also consider the value of intangible assets. And when I looked at the top holdings in these ETFs, one is ticker symbol I10. So the top holdings are Microsoft, Amazon, Facebook, Apple, and Google. So this looks like QQQ. Wow. Basically, there's another.
Wow, that's crazy.
Yeah, I know. This is an actively managed ETF. And there was the other one, which I mentioned, the ticker symbol is NBQ. That uses AI to identify these value stocks. And when this ETF had launched, its top holdings were also Amazon, Google, and Facebook. Though when I checked the holdings today, it seems that AI is now more interested in T-Mobile, AT&T, CVS, more like typical value stocks. So I saw that you did a podcast recently on the new era of value investing, and I found that episode very interesting. Yeah. So talk to us about your new definition of value stocks.
Yeah, I'm not surprised that there's these new ETFs launching with these kinds of strategies, because there is a way to do value investing outside of the classic way. I think you can kind of do a combination of them now. And the way that I couched it was, as you said, this new era type of investing where you're comparing companies based on peers, on their industry, or maybe even just, that the stock has gone on sale. So that's a little bit different than just looking at a low PE, for instance. And as that one ETF you just mentioned, you may, if you include things that are outside of the earnings in your evaluation, you're going to get a lot of different types of stocks. You may even get some that are not currently, earnings positive. And so, but there may still be value there. So yeah, I like looking at both. I don't think you should only use the classic value type of investing. And so that means you can capture some of these newer, innovating type companies that maybe are hard to classify under the old way.
Okay, now let's talk a little bit about the outlook for value stocks now. You mentioned that value had been out of favor for the past many, many years because, FANGs were doing so well, technology was doing so well, so investors kept piling in those FANG stocks. But late last year, value and cyclical stocks staged a very nice rebound. And in fact, there was an article in the journal in March this year that value stocks are beating growth stocks by their widest margin in 2 decades. And in recent weeks, we have seen these rotations in and out of value stocks, cyclical stocks into growth. But in general, investors have favored FANGs and Microsoft. Uh, Today's looks a bit different. So, what do you think? What lies ahead for value stocks for the rest of this year?
Yeah, I think a lot of banks are considered to be values right now. And so some of the bank recovery that happened to start 2021, along with energy, which was through the summer of 2021, the best performing sector, both of those were beaten down and have staged recovery. So that has helped the value type play because a lot of those are pure play values. Some of the other areas like agriculture, that is cyclical, and even to some extent, some of the semiconductors can fall into the value camp as well. And when those stage recoveries, and agriculture certainly has as well, then that helps the value. So the outlook isn't bad here for value because there still is a lot of it. Because we're at peak, for classic value, we're at peak earnings right now. So the E is quite high. And a lot of the cheap stocks right now are kind of out of favor, I would say. I think people are waiting to kind of see what happens in the recovery and what happens to earnings, maybe going into 2022. They're not certain that this earnings peak can hold up here. So I'm still pretty bullish on a lot of the cheap stocks right now. And even on some of the growth names that have gone on sale, I'm pretty bullish on those, the new era type of value investing. So it's not a bad time to be a value investor here.
Yeah, definitely. Even the broader indexes are up 21% this year. But most of the expansion this year, most of the rally this year has been due to growth in earnings. Multiples haven't expanded much, so valuations do look attractive, particularly for certain stocks. Now, let's talk about your favorite value stocks. And you have a mix of both classic value and the new era type of value stocks. So let's start with Pinterest. So this is a new era type of value stock, right? Because it is trading at a forward earnings multiple of almost 51 times. And the stock did very well last year, basically, because everyone was stuck at home and they were spending a lot of time on social media, including Pinterest. And there has been a lot of growth in active users, but not at the pace which we saw last year. So probably that's why this stock is down over the last 3 months. Talk to us about Pinterest and why you like it.
Yeah, Pinterest is an interesting play here on social media. They've been moving pretty aggressively into the shopping type of features, and that's helping on the revenue side. They also were mostly North America, and only in the last couple of years have really branched out. And they only just added like certain countries like Mexico onto the platform. So they're kind of behind what everyone else has been doing. But I like that because that means the growth trajectory is still quite enormous when you think about all the different markets they can still enter into. And they're still really building out over in Europe as well. And they've only added like the shopping features into several key European countries like France and Germany just recently. So they're still in the early stages of the growth mode in a lot of their new initiatives. So it's not so much just about pinning. I know a lot of people remember, pinning cooking recipes on it maybe 5 or 6 years ago. And then they kind of just said, okay, that was fun and went off of it. A lot of it is now shopping based, and they're moving pretty aggressively towards video as well. So those are a couple of things to watch with them. The shares are down big over the last 3 months, over 16%. They pulled back here. I do still consider it a buying opportunity, even though that PE is at 50. because the E is they only had positive earnings in the last like 2 years. And so they're still in the early stages of growing that E side. I'm not too concerned about it because they're really growing that revenue side pretty strongly right now. So you're going to see improvement on the earnings. And people did get spooked by the fact that they did lose some of their users on the economic reopening, because as you said, Nina, that we all weren't stuck inside. So we decided to put down our phones and go out into the world a bit more. But they were warning about that, even leading up to the quarter where they actually did show the decline in users. But the revenue is still going in the right direction, like I said, and they're going to start to see some more contribution from some of these other countries that they're entering into. So Pinterest is an interesting play. If it has further weakness here, then I would definitely be a buyer on any further type of weakness. But this is a multi-year story that is still in its early stages.
Yeah, definitely. The long-term growth potential looks very, very attractive.
Yeah.
Now, your second pick is an auto stock, which is up almost 50% this year, but it is still cheap with a forward PE of just 6.6 compared to 50 for Pinterest. Now, autos are very hot this year. Of course, it's very difficult to find a car or a truck used or new. That is because of this global chip shortage that we have seen, and also supply chain disruptions. Talk to us about this stock.
Yes, Penske, ticker PAG. There's a lot of auto retailers out there that you can choose from. I chose Penske, and I really like it because they're a little more diverse than some of their competitors. So they do own auto dealerships around the United States, but they also have quite a few over in Europe, including in the UK and Germany, a couple other countries. So that gives them a little bit more diversity in terms of, at least right now during the pandemic, if one country has a shutdown or something's going on, other countries may be already, done with their outbreak and reopening or whatnot. So it gives them a little bit of a cushion there. And they also sell both new and used. So even though the new car market's a little more challenged now, if there's not much supply out there, same is true somewhat on the used side, but they have at least both areas operating. They also do maintenance and repairs and all of that. So that's, again, another area that has been strong. But Penske also does a little bit on the trucking side. They own a portion of a logistics company, and we all know that that's been red hot. And they also have some truck dealerships. So I like the combination of everything that they're involved in. And as we know, auto sales are super hot. So the earnings are expected to be up almost double this year versus last year. But next year is where it gets a little bit iffy because they are expected to fall back. This year is going to be a record year for Penske. But next year will still be well above the pre-pandemic levels. So even if we see next year's bigger earnings decline, it'll still be a cheap stock. It'll still only be trading around 8 times, even with that earnings decline. So I like all the auto retailers. You can't really go wrong because I think auto sales are going to remain hot, at least into 2022.
Right. It seems that this global chip shortage and the supply chain disruptions will continue for some few more months at least, because COVID is still spreading in parts of Asia. Now, your third pick is a beauty stock, and this is again a very cheap stock like Penske, but like Pinterest, it has fallen in the last 3 months, and now it looks attractive. Very attractive compared to its earlier valuation. So talk to us about that.
Yeah, New Skin. It's ticker NUS. And they've been around for forever, it turns out. For 35 years, they've been around. But part of the reason that maybe you've never heard of them is because they had a different model. they had the model of, say, Tupperware or Avon, where they had, like associates selling the products out there. And now with, online e-commerce, all of that, you don't really need the associates. You don't need the Tupperware salesman anymore if you are just selling it on your own website type of thing. So they've made a big transition back over to digital type of marketing and a digital company. And so one of their big things is to sell on social commerce, is what they call it. And that is, all of the big social media platforms. It's like ideal to sell the products that they make. So they're big in beauty, as you said, and they have some beauty products, kind of like cleaning systems or like spa systems for the face. I kind of liken it to the old Clarisonic, which actually just shut down its business, but like that kind of device. Also does a lot of lotions and beauty skincare products and wellness. They have some collagen products and multivitamins, things like that. And the other interesting thing about them is that they're very heavily in Asia, where they take beauty very seriously, all of these types of beauty products. So they've been very popular,
Right.
very popular there. Like I was, I'm surprised that about 12% of their revenue comes from South Korea and about 10% from Japan. So those are both like kind of considered beauty capitals of like new products and things. So they're able to market and compete and be strong in those areas. So I really like anything in the beauty area. And Nu Skin now, they've the shares have fallen back the last couple of months, and they're trading, as you said, really cheap with a forward P of just 11. They also are super shareholder friendly. They have a lot of cash flow because their gross margins are at 75.6% for this last quarter. So I love any company with that level of gross margins. Sure, sign me up. They have a dividend yielding 3% right now, and they're doing share buybacks. So I like the beauty area. Again, you do have to pay attention to what's happening with COVID outbreaks. They have seen some impacts over in Asia due to the most recent outbreaks, they said on the last conference call, but that should be temporary. And, business should resume. And again, a lot of it is digital. So it's still easy to order the products you need or whatnot, even if, you might have some COVID restrictions or things restricting you otherwise from going into like a physical store. So yeah, Nu Skin NUS is an interesting, cheap play on what's going on with beauty right now.
So Pinterest, Nu Skin, and Penske, definitely very interesting picks. And if you want to learn more about Tracy's favorite value stocks, then please visit Zacks.com and look for Value Investor Portfolio. Tracy, that was very interesting. And I wanted to talk a little bit about some of the ETFs that investors could use if they don't want to invest in individual stocks, or they can buy both stocks as well as ETFs. Now, the most popular and very cheap, one of the cheapest value ETF is by Vanguard. It is the Vanguard Value ETF, ticker symbol VTV. This tracks the US large cap value index, which basically uses a combination of multiple value factors to identify value stocks. It has over 85 billion in assets and charges just 4 basis points. Now, if I look at the top holdings, Berkshire Hathaway, JP Morgan Chase, Johnson & Johnson, and United Health. These are the top holdings in this ETF as of now. Now, the ETF which has in the space, in the value space, which has done best, which is the best performer this year, is the Invesco S&P Small Cap Pure Value ETF. So this basically looks at small cap stocks which have the purest, best value characteristics. So we know that this combination of small caps and value was very hot. It was almost magical earlier this year and late last year. So that is why this ETF had done very well earlier this year, still doing well. This has about 282 million in assets and charges 35 basis points. Now, this is going to be volatile because it focuses on small cap stocks. So if you prefer not to invest in small caps in this uncertain economic environment, and you prefer the safety of mega caps, but you want to still focus on value, then you could look at the Vanguard Mega Cap Value ETF. The ticker symbol is MGV. This has more than 4.5 billion in assets and has an expense ratio of just 7 basis points. Now, another value ETF, which I like, and I think it's very interesting, it has been doing well lately. It's by Alpha Architect. It is called the Alpha Architect US Quantitative Value ETF. This has 223 million in assets. This uses quantitative screens, and it basically tries to identify highest quality value stocks. And in fact, I did a podcast also with the ETF providers, so you can listen to that podcast and read our articles and reports on this ETF and other ETFs. Tracy, thanks so much for joining us today. That was really interesting discussion.
Yeah, it's great. And it's interesting to hear about all these really unique ETFs that are going into the value area as well.
Yes, and there's been a lot of inflows into value ETFs this year, particularly the larger ones like VTB. They're very, very popular with investors this year. So probably we'll talk about value investing and value stocks and ETFs again soon.
That'd be great.
Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.